Securities lending is a well-established market where an investor temporarily lends securities to a borrower in return for a fee. Securities can either be bonds issued by governments or corporates, or shares in public companies. In addition to the fee, the borrower provides the lender with collateral in the form of other securities or cash. This protects the lender from the risk of potential loss if the borrower is unable to return the lender's securities. The value of the collateral is normally greater than the value of the borrowed securities, providing additional protection for the lender. To protect both parties against market fluctuations during the life of transaction, securities on loan and collateral are revalued daily. This is referred to as mark-to-market. At the end of the transaction, the borrower and lender return their respective securities and collateral to one another. In summary, securities lending is key to efficient and robust capital markets, while it also provides a low-risk way for investors to generate incremental income. Lenders are commonly investors such as pension funds, investment funds including UCITS, insurance companies and sovereign wealth funds. As they typically invest against a long-term horizon, they do not need to access their securities on a daily basis. Therefore, by lending them, they can receive additional income in the form of a fee from the borrower, without losing the benefits attached to those securities such as dividends or interest payments. The additional revenue generated can help reduce costs for investors, including pensioners. Borrowers are typically banks that need to borrow securities for three main reasons. First, to guarantee efficient and liquid markets. Banks usually commit to buy and sell certain securities at all times. This is called market making. They can be required to make markets by their clients, by regulation, or even by governments in the case of government bonds. Yet, banks do not tend to warehouse securities. Therefore, access to securities lending markets is critical for them to be able to make markets in securities they may not physically hold. Secondly, regulation requires banks to hold enough, sufficiently low-risk assets such as government bonds to ensure their own financial health. The securities lending market can therefore act as a primary source for borrowing these assets. Finally, banks need access to securities to service the different needs of their clients, be it support for certain trading strategies or to cover for the risk of their counterparties failing to deliver securities in cash equity stock markets. To summarize, securities lending makes for healthier and safer financial markets by increasing returns for investors, supporting the needs of different market participants, and helping them meet their regulatory obligations. Firstly, securities lending makes financial markets function better. It helps banks meet their market-making obligations, ensuring markets remain open and liquid. This allows for better price transparency for investors and ultimately reduces costs for companies and governments looking to raise money in the capital markets. Secondly, securities lending makes markets safer. It reduces potential operational settlement risk and ensures broader financial stability. By allowing market participants to borrow securities to cover certain transactions that would otherwise fail, securities lending supports high levels of settlement efficiencies across financial markets. Also, post-financial crisis reforms have put many safeguards in place to protect investors, market participants, and market infrastructures. Securities lending is one of the essential mechanisms by which high-quality assets can be mobilized and transferred to meet such requirements. Thirdly, securities lending increases returns for pensioners and savers. It creates additional supply of capital in the financial markets, which flows back to the investors. Many European and other central banks use securities lending as part of their implementation of monetary policy, which helps financial markets function more smoothly. For all these reasons, securities lending is often a priority for governments in emerging markets seeking to create and develop efficient capital markets. Initiatives to improve existing capital markets, such as the EU CMU project, equally benefit from securities lending. In conclusion, securities lending benefits financial markets by providing an efficient and low-risk mechanism, by which the differing demands for securities can be met, whilst offering additional return to investors.